Hello everyone, welcome to Oliveboard. So in previous session, we have already completed our complete revision of Module A of paper ABFM. So now today we have to start the complete revision of our Module B. So in this Module B, we will be revising each and every concept that are relevant for your exam. So let's start the series. Let's start our topic. First, we have to start our new module, that is Module B. We have completed Module A, and total 6 units were there in Module A, starting from basics of management till controlling. We have completed each and every important concept related to such topics, such unit. So in Module B, we will be starting with our Unit 7. Today, we have to complete Unit 7, all the important concepts. And the name of the module is that is Sources of Finance and Financial Strategies. So in Module A, we have seen that how to manage a business. Okay, we have seen the management perspective, how we plan our activities, okay, how we organize into similar nature of groups, similar nature of activities together. If any mishappening occurs, how do we control that? Okay, how we read the market phenomena, the market structure, all the internal as well as the external factors. So all these things we completed in our module A. We have read all these things. See how to manage a proper and healthy business. Now in module B, what we have to learn, what we have to study that how we will going to procure our funds, how we will going to use our finance in various sectors, what are the sources of funds, all these things, all the things related to finance, related to money, you will going to study in this particular module, that is module B. Various types of decisions, how you will going to take decision for any kind of project. If you are thinking to invest on any project, how you will going to decide that, what are the techniques you will follow, that everything related to such things we will study in this particular module, that is module B. And today we have to study that what are the sources of finance, how many types of capital are there, what are their work. So this thing we will study today. So let's start the session. And if you are new to this channel, I highly request you to subscribe the channel. If you feel that my videos, my sessions are helpful to you, if you are gaining any knowledge from my sessions, kindly like the video and share it with others as well. Now, let's start with the session. So, sources of finance. Sources means the places from where we can arrange our funds, where we can arrange our finance. Clear? So, there are basically two types of sources basis of time, that is the time period, the sources of finance time period, and basis of ownership means the owner. On the basis of time, we have two types of sources of finance. The first is short term and the second is long term. Short term means what? Short term is a finance which is less than for 1 year, less than a year. Whereas long term sources of finance are those finance which are more than for a year, more than for a year, for 5 years, for 10 years, for 15 years, like this. On the basis of ownership, again, we have two types of sources of finance. That is the owner's fund. Owner's fund means what? I'm the owner of the business. I'm using my own capital for the running of business. So this is what owner's fund. Second comes borrowed fund. Borrowed fund means what? I need some more amount of capital for my business. So where I'll be going? I'll be going to any financial sector, any banking sector, borrow such funds. So borrowed funds are the funds from such institutions from where we can borrow the funds which we need in our business. Now next comes equity capital. What is equity capital? Who are equity capital, equity shareholders? Suppose let's take an example. Okay, this is a person named A, and this is a company, let's say ABC Limited. Now, this particular person, okay, wants to invest in this company. So what he will do? He will going to invest in this business. He wants to do an investment, so he will become the investor. Now, if he wants to invest in this business, so business will give him what? If this person will invest, he will give first what? He will give rupees. And in return of that shares, ABC Limited will what they will sell their shares to this particular person A, and in return of these shares, the particular person will invest in rupees to this ABC company. Now, when he is investing in this company, then he is taking a part of the ownership. And when this person takes the part of the ownership, this person becomes a equity shareholder. Now read this bookish language. Equity capital represents what? They represents ownership in a company. When any investor, this is the investor, purchases shares. This investor is purchasing the shares of ABC Limited, and instead of these shares, he is investing in this particular company. They become part owners and have a claim on the company's asset. Now he has become the ownership of the company. Now he can claim all the assets of the company, all the profits of the company, all the bonus of the company, the dividend of the company. So he or she can claim all these things. So equity capital refers to the fund raised by a company through what? Through the sale of shares. Equity capital are such type of capital. They are such type of funds which is being raised by a company through the selling of its share. In account is the amount remaining after selling all the assets and paying out the liabilities. So equity capital have different features. Okay, they are the ownership of the company. They are the owners of the company. They participate in all the matters of the company. They participate in the profits of the company, in the dividend of the company, in all the internal affairs of the company. Equity capital, or you can say long-term loans, each have a distinctive advantage, and the choice between depends on a company's specific circumstances. Why business will prefer equity capital over long-term loans? Why we prefer equity capital over the loans? Because in equity capital, you don't have to pay any kind of obligation. If you are taking the help of loan, then you have to pay interest. But equity capital, in your if you are taking the help of equity capital, you don't have to pay interest on a regular basis. There is no obligation to repay the interest. Risk is shared because equity capitals are a bit risky one, and the risk will be shared to every person who is in that particular business. They have their own experience, expertise. So they bring what? Valuable expertise, network, mentorship, because they are highly risky. If such investors are in this case, if such investor is investing in this particular business, so definitely this investor has some years of experience. He has a lot of business ideas. He has a great business model. That is why he is investing. And this company is seeing that, okay, this person is very profitable for my business. Okay, let's sell our shares to this particular person and let's make this person as equity shareholder. So they have expertise. The financial burden is less. If you are taking the loan instead of equity capital, you have to pay interest. You have to pay the interest principal plus interest amount. Whereas in equity capital, you don't have to pay any kind of interest. Why? Because they are owners of the company. You only have to pay the dividend profit to them. The ratios will be improved by relying more on equity can lead to stronger debt to equity ratio. So if you will rely more on your equity shareholders, then what happens? You will going to take your debt less, and if the debt is less, then debt to equity ratio will become more stronger, and hence it will tell the credit worthiness of the for future financing. Flexible growth, there is being a flexibility for long-term growth and strategies. Why? Because there is flexibility that if any business, like suppose ABC Limited, the example which I have taken. This ABC Limited, suppose year 2023, 24, 2024, 25. And let's take one more example, 2022, 2023. In this year, he made a profit of 1 crore. In this year, he made a profit of 80 lakh rupees. Now, in this coming year, he is making what? He is making a profit of, let's take an example, 60 lakh rupees. So as you can see that the profits are decreasing. Okay, so decreasing, they are decreasing. The profits are being made in a decreasing order. So equity shareholders will also get a profit in a decreasing order. They will get the dividend in decreasing order. So they have a flexibility. It is not that every month, every year you have to pay them a certain profit. No. As the company earns the profit according to the profit level, according to the loss level, they have to pay the profit. If the company makes a loss for a certain year, then they will not be given any kind of profit, like, and vice versa. Now, what are internal accruals? Internal accruals are, see, when a company makes a profit, after this profit, it depends on the company that whether the company is distributing the profit as dividend to its shareholders or they are keeping it as reserves. If the company is keeping all the things as reserves, then they are their internal accruals. And how profit is being calculated? You have sales. If you will deduct your variable cost, you will get contribution. If you will deduct the fixed cost, you will get EBIT, that is earnings before interest and tax. Less interest, earnings before tax. Less tax, you will get earnings after tax or PAT after tax. It means this is the amount, this is the real earnings which you will going to divide among your shareholders or you will keep it as reserves. So the amount which you are keeping as reserves is your internal accruals. As a measure of financial prudence, no company can would like to distribute the entire earnings after tax to shareholders. No company will distribute all of its earning to shareholders. They will keep a few portion of their earnings as reserves and which is known as this retained profit are internal accruals of the company that rise out of the cash profit. There are also dividend distribution rules. Okay, and after when you get your PAT, that is what your retained earnings. And these retained profits are what internal accruals. Now, what are preference capital? Again, in the same manner, the equity capital, there are preference capital also. Preference capital, preference shareholders. So capital, it is the money company raises by selling what? By selling its preference shares to all the investors. Similarly, in likewise equity shares, they also sell their shares to the investors, and investors become a part of the preference shareholders. So if you will see this word preference, preference means what? Such investors will get a sort of preference. What preference? Whenever company makes a profit, okay, in this profit, first the dividend will be given to whom? These preference shareholders. Whatever earnings is being left, the first dividend, the preference is given to them. After that, whatever is left, then it will be divided among equity shareholders. The preference shares type of share capital that gives investors, they have certain rights over a company's asset and earnings. They have only few rights, not all the rights which equity shareholders the company give them. No, they only have a negligible or few rights. As the name suggests, the holder gets what? A preference. Preference of what? A dividend. In case as well as payment in case of liquidation. When the company liquidates, first of all, the payment is given to whom? Preference shareholders after paying all the debts, all the liabilities. First preference is given to preference shareholders, then equity shareholders. So they are kept one level up from equity shareholders. So what are its features? They have a dividend preference. They get a fixed dividend. Dividend can be fixed or variable. If it is variable, it has to be mentioned in the document, or else most of the time the dividend of preference shareholders they are fixed. Liquidation preference, when the company gets liquidates, these are paid before common shareholders. Now, what are common shareholders? The other name of common shareholders is equity shareholders. Convertibility, these preference shareholders can be converted into equity shares after a with specified time. After a time period, they have the chance to convert into equity shareholders. They have the voting right, a few voting right, or a negligible voting right as well. Redemption rights. Some preference shares may be redeemable. They can redeem. Okay, a specified time is being mentioned. That is, the company can buy back the shares of these preference capital. They have a fixed maturity. Preference shares may have a set maturity date. That is, they can be redeemable. A fixed time period is being mentioned. Now, what are debentures? Debentures means what? Simply debentures means debt. Debt means loan. Word debenture, it is a derivation of the Latin word debere, which means to borrow. So this section is important. According to Section 2, subsection 30 of Companies Act, debenture includes debenture stock, debenture bonds, or any other instrument of a company. Okay, that determines what a debt, and a debt means what a borrowed money or loan. So when company takes a loan from such debenture, then they become the debenture holders of the company. And these debenture holders, they get what? A fixed interest payment because they provide a sort of loan to the company. And in return of that loan, company pays what? A fixed interest rate that is paid to these debenture holders. So debenture is document that acknowledges a loan and contains what terms and condition of the loan. The same term and condition what the loan carries, the same they will also carry. In loan, what company has to do, if a company takes a loan from a bank, they have to pay the principal amount plus the interest amount. In the same manner, a company has to pay to its debenture holder the rate of fixed interest to them, including what the interest rate, repayment schedule, a particular time is being mentioned over there. So debenture holders, they become what? They become the creditors of the company, and the company has the liability to pay them a fixed rate of interest. And likewise, preference shareholders, they also don't get voting right, unlike shareholders means the equity shareholders. In equity shareholders, they get a voting right to participate in the company's matter, but whereas debenture holders do not have any kind of voting right to participate in any company's matter in any internal affairs of the company, that is general meeting. Now, what are the features of debenture? Again, they are instrument, an agreement or deed. Everything is written on that agreement. Okay, what type of loan you are asking, the convertible loan, non-convertible loan. Then the borrowed fund is at you will get a interest, a fixed rate of interest should be determined over there. A fixed time period should be determined over there. No voting right is given. Stake in the company, they will become what? Debenture holder. They will become what? Creditor. They have the options with the issuer and options with the investor. So these are the few features of what? Debentures or debenture holder. Now, they have borrowed funds. This is what the company borrows from them, the debentures. Fixed rate of interest, they have a fixed rate of interest. Like if the debenture holder's interest is 10%, it means if they have given 1 lakh to the company, so you have to pay 10% as interest in this 1 lakh rupees. Compulsory payment is there, like wise loan. In the same manner, we pay a loan, we have to pay interest to these debenture holders. Proper secured, these are secured as unsecured. Means you can keep as collateral as a security, and you can also take the loan as unsecured, means no collateral is being put when taking the loan. Redemption, these can also redeem, that is company can buy back the shares after a certain date, buy back shares after a specified period of time. And again, they have no voting rights that is being mentioned over here. Now, this one term in our module B, Unit 7, that is foreign direct investment, FDI. So FDI again, it consists one more word, that is FPI. It is similar to this word, foreign direct investment and foreign portfolio investment. So direct, see, whenever you are investing in any country, okay, you are investing, suppose you have got a chance to invest in particular project of this company. Okay, this company is being situated in USA. Now, you are saying that this project is very good, it will give me a good return. I will be earning more in USA because you know that in USA the dollar is being appreciated. The rate of the dollar is high than the Indian rupee. So foreign direct investment means what, you are making a control in that company. If you want to make a control, if you want a control of that particular company situated in this particular country, then you are doing FDI. If your intention is only to earn profits from that company, if your intention is only to earn profits from that company, then what you will do, you will do FPI, that is foreign portfolio investment. So FDI is what, when a company or individual from one country invests money in a business to another company. When one company invests the business of another company situated in foreign country, that is FDI. For example, like factory setup, okay, in doing any kind of operations in that country, and allows investor to have control over the business. FDI, it gives what? It gives the control to that business, and from this control, they will make a huge. FDI is what? It is again, it is divided into two routes, the automatic and government. In automatic, okay, full-fledged freedom is given that you can go and you can do the business. Whereas in government route, okay, after a percentage criteria, you need to take what? You need to take the permission of the government. Then only you can go and you can invest in other country. So in government route, the permission is required. Whereas in automatic route, no permission is required of the government. No permission is required of government. It refers to an ownership stake in the foreign company project made by an investor. Such as if you are investing in any other foreign country for the purpose of control, that is FDI, and if you are investing in any country for the purpose of only just to make profit, that is FPI. So this is very important. Foreign direct investment in India is governed by whom? It is governed by a FDI policy which is announced by the government of India and the provisions made under Foreign Exchange Management Act. So this FEMA came after the replacement of what? FERA. Before it was FERA, now it is FEMA, Foreign Exchange Management Act, and it was Foreign Exchange Regulation Act. In FEMA, we have total 49 sections, and in FERA, there were total 81 sections. Before that, we have completed our Module A. I hope you all have watched all the sessions of Module A, starting from Unit 1 till Unit 6. And today we have to cover Unit 8, that is all about leverage. We will be learning the what are leverages. We will be doing some practical questions related to leverage. So yes, let's learn about leverage. That is what our unit is, the leverage. Leverage is what? See, simply leverage means a one word of leverage means that is what? That is debt. And debt is what? Debt is a borrowed money. This is the definition from the perspective of financial. But in the real life, in the very simple layman language, what is leverage? It is ability to influence situation of people so that you can control what happens. You can control the situation, you can control the circumstances. So it is basically what persuading the people so that you can control their situation. This statement is very important. Galileo said that give me a point of support and I can lift the earth. So leverage basically is what? It is the support. With the help of that support, how much you can lift up. That is, this is the support, and this person is Okay, this person is bending down to lift up this person. Now this person will bend down to lift up this person. That is what leverage is for. It is a type of support that a company gets, that a business get in the form of debt to finance their business, to improve their business, to conduct their day-to-day operations of the business. That is what is leverage. Am I clear with the basic definition of leverage? Leverage in financial terms, again, it is the use of what? Borrowed capital. Borrowed capital is the capital which you have borrowed for your organization. Like you have borrowed from any banking institution, you have borrowed from any financial sector. So all these are what? All these are debt to increase the potential return on an investment. It allows individuals or companies to amplify their investment to increase their investment capacity by using what? Debt. This is the biggest keyword of leverage, that is debt. We have total three types of leverage. The first is financial, second is operating, and the third is combined. Combined means what? You can also say the total leverage. Again, it means what? The combination of financial leverage plus the combination of operating leverage. We have these two types of leverage. Now let's do one by one. What are financial leverage? Financial leverage simply means the borrowed money. The money which you have, which a company borrows from its investors, which a company borrows from any banking institution. It's when a company or investor uses borrowed money. The one which I'm highlighting or keeping in a box, that is very important. To invest in something with the goal of making more and more money. What happens? For what purpose you will borrow money? Either you will expand your business, then you will borrow money. If you will invest, then you will borrow money. If you will purchase capital assets, then you will borrow money. If you have to pay loans to the to your if you have to pay money back to the investors, to the shareholders, then for those reasons you can borrow money. So there are many different reasons why you borrow money than the cost of the loan, making more money than the cost of the loan. And see, like you have different projects. Project 1, project 2, project 3, project 4. It means what? For if you are investing in this particular project, the cost of this project is, let's say, 10 lakh rupees. But you have only 8 lakh rupees. Now you want more 2 lakh rupees to invest in this particular project. So for this 2 lakh rupees, where you will be going, you will be taking the help of any financial sector, any banking sector. Now from this bank, you will take the loan of 2 lakh rupees. After the repayment date, when the repayment due date comes, you have to pay the 2 lakh rupees plus the amount of interest. So sometimes what happens, this amount of interest, this becomes the burden of the company because the principal amount you have to pay back, and with that you have to pay the interest also. So financial leverage, this considers what? EPS, earning per share, means the value of earning is what? Per share value. EPS, that is earning. What is your earning on the per share? That is in one share, how much you are earning. Okay, what is the value of one share? Yeah. So then now formula of financial leverage is what? It is percentage change in EPS upon percentage change in EBIT. And financial leverage formula is earnings before interest and tax upon earnings before tax. This is the formula of financial leverage. So before get going to this formula, let's do one question. Okay, let's do the income statement. There is one income statement, and in from this particular statement, the whole leverage is being dependent on this particular statement. If you learn this statement, if you learn all the formulas, then you can easily do all the questions related to leverage. Sales are there. If you will deduct from sales the variable costs are the cost which changes as the output changes. Here, what you will be getting contribution. Now, from this contribution, if you will deduct the fixed cost, what you will get EBIT, that is earnings before interest and tax. From this earnings, deduct interest. What you will get? EBT. That is earnings before tax. Now, what you have to deduct? You are getting earnings before tax. So what is the earnings after tax? For this, you have to deduct the tax. Then you will get earnings after tax, or you can say one more name, that is profit after tax. Either you can say earnings after tax, or you can say earnings, or you can say profit after tax. Profit after tax. And this particular profit is distributed among what? Among the shareholders. After paying all the liabilities, after setting off all the debts, this particular profit will distribute among the shareholders. And if you have to find the value of one share, okay, value of one share, just divide profit from number of shareholders. So you will get the value of one shares. Am I clear with this income statement? This is very important. The whole leverage is based on this particular statement, that is income statement. Now, now let's do a question. Okay. What you have to find? You have to find degree of financial leverage. So formula of financial leverage is what? EBIT upon EBT. Degree of financial leverage is a leverage ratio that measures what? The company's earning per share to its fluctuating operating income. Means the how much the income increases, according to that the earning per share also increases. Clear? Earning per share. EPS means earning per share. It includes basically what? The borrowed money, the financial money, the borrowed money, the debt, financial leverage. Now, let's do a question. Okay. Question is given, sales is given, how much? 24 lakh. Okay. Let's write the sales. Can you all solve this question? I'm giving you 1 minute, solve and tell me the answer. Minus variable cost is what? 50%. 50% means 24 lakh into 50%. That is 12 lakh. Okay. What what you will get? You will be getting contribution. If you will deduct variable cost, you will be getting contribution, that is 12 lakh. Now, in contribution, if you will deduct the fixed cost is how much? 10 lakh rupees. Deduct 10 lakh. How much is the value you will get after deducting 2 lakh? Then what this come? This will come EBIT. Then deduct what? Interest. Interest is given. It it has borrowed 10 lakh at 10%. Means this 10% is what? This 10% is interest. Now, 10% of 10 lakh is how much? That is 1 lakh. Deduct it, write 1 lakh. Tax. Deduct tax. Tax is what? 50%. So 50,000. 1 lakh. 50% of 1 lakh is 50,000. What comes? 50,000. So this is earnings before tax. Now this is profit after tax. So this is the profit after tax. And now tell me, what is the formula of this? EBIT upon EBT. Financial leverage formula. So EBIT is how much? EBIT is 2 lakh rupees. EBT is how much? 1 lakh rupees. So how much is the answer? That is 2 times. Am I clear with this? So 2 times is the answer. Tell me, any doubt to anyone? Is this question clear to you? So in this way, we will calculate our financial leverage. Now, let's do the next topic, that is operating leverage. What is operating leverage? It is operating means what? It will include all the operating costs, all the fixed costs. It means that if the operating leverage, if the operating costs are high, then small increase in the sales can lead to a big increase in profit because its fixed costs stay the same. We know that fixed costs, they do not change. What changes? The variable cost changes. So operating leverage tells us to understand it, help us to understand about the company's cost and profit with regards to sales. As your sales will increase, the profit will also increase. As your sales will go down, the cost will increase and profit will go down. So it basically helps us to tell the relation between the sales and cost. If sales will go down, profit will definitely go down because fixed cost is still there. You have to pay your fixed cost. They will never change. Either you are earning 10 lakh rupees, your fixed cost is same, or you are earning 10 rupees, your fixed cost is same. What are the fixed costs? Like rent of a suppose you have a factory. Okay, a factory is being situated. You are working, your employees are working there. Now every month you have to pay the rent of that factory, whether you are whether the production is being done in that factory or not, it doesn't matter. You have to pay every month 10,000 rupees as a rent of that factory. You have to pay that. That is fixed. It will not change. But variable cost, this will change as the production increases. When you are producing 10 units of goods, the variable cost is different. Now you are producing 10,000 units of goods, the variable cost is according to this. It will change as the sales change. Operating leverage, it basically tells that as the sales changes, the profit changes, and as the sales will go up, then profit will go up. Sales will go down, profit will go down, and cost will go up. Yeah. Hmm. What is the formula of operating leverage? The formula of operating leverage is contribution upon EBIT. This is the formula of operating leverage. And we have seen this particular chart. We have seen this particular chart. Now, can you all solve one question? Tell me. Okay. So here is one question. Now solve. I'm making the chart over here. Sales minus variable cost, contribution minus fixed cost, EBIT minus interest, EBT minus tax, EAT or PAT. That is earnings after tax or profit after tax. What is the formula of operating leverage? The formula is given contribution upon EBIT. Sometimes what happens? They will give you the sales minus variable cost. So if you will deduct sales from if you will deduct a variable cost from sales, what what you will get? You will get the contribution. So simply contribution upon EBIT. The formula of operating leverage is contribution upon EBIT. Now please solve. I'm giving you 1 minute. Solve this question and tell me what is the answer. And kindly please like the session if you feel that these sessions are helpful to you. Then please like the session and share it with others. Okay, I'm waiting for your answer. Calculate degree of operating leverage when a company sells 1,000 units of product at rupees 50. So sales are how much? 1,000 units at rupees 50 means the value of per unit is given to you 50. It means sales are how much total? 50,000. Variable cost is how much? Of rupees 30 per unit. How many units are there? There are total 1,000 units. And the rate per unit is how much? 30. Again, 30,000. Fixed cost is how much? Fixed cost is 15,000. Now simply put all these value on this particular formula. What contribution is how much? Contribution sales is how much? 50,000. Less variable cost. Variable cost is how much? 30,000. How much you will get? You will get 20,000. This is your contribution. So you have got your first part. Contribution is 20,000. Now EBIT. In EBIT, what you have to deduct? You have to deduct fixed cost. How much is the fixed cost? That is 15,000. You will get 5,000 as what? EBIT. Now, you have got your EBIT as 5,000. Simply what you have to do? 3030 cancel 5 fours are 20. That is 4 times. So operating leverage is how much? It is 4 times. Here, tell me, any doubt? It means if your sales will increase to 4 times, the profit will also increase parallelly. Now, next, last type of leverage is what? Combined leverage, or you can also say total leverage. Here, total leverage is what? That is fixed financial leverage into operating leverage. You will be getting total leverage. Now, what is the formula of financial leverage? Formula was EBIT upon EBT into, see, remember, if you want to find combined leverage, don't never do plus. Okay, every time you have to do multiply. You have to use this sign instead of plus. You will think it is a combination of two type of leverage. Let's do addition. No, here addition will not work. Here multiplication will work because you will seeing the amount is coming in fractions. Okay, the formula is a fraction. Into operating leverage is contribution upon EBIT. So from cross multiplication, EBIT gets cancelled. What remains, that is contribution upon EBT. So this is the formula of combined leverage, contribution upon EBT. Now, so we have done financial leverage, we have done operating leverage, we have done combined leverage. Now I'm giving you one question where you have to find the financial leverage also, operating also, combined also. Calculate and tell me all three types of leverage. Operating leverage is contribution upon EBIT. Financial leverage is what? Tell me, tell me the formula of financial leverage. Just now we have. Anybody, please tell me the formula. EBIT upon EBT. And what is combined leverage? Contribution upon EBT. Now calculate and tell me what should be the answer. I'm giving you 1 minute time. Here sales are given how much? 10 lakh rupees sales. Okay. Simply write sales 10 lakh rupees. Deduct what? Variable cost. Variable cost is given how much? 7 lakh. Deduct variable cost, it will come 3 lakh rupees. 3 lakh is what? 3 lakh is contribution. Now, deduct fixed cost. Fixed cost is how much? 2000. 1 lakh is what? It is EBIT. Deduct interest. Interest is 10%. On how much? On 5 lakh. So 10% of 5 lakh is how much? That is 50,000. EBT. Now, we have to find till EBT. Contribution upon EBT, contribution is 3 lakh upon EBT is 1 lakh. What is the answer? That is 3. EBIT upon EBT financial leverage. Financial leverage, if you will see EBIT upon EBT. EBIT is 1 lakh rupees. EBT is 50,000. What will be the answer? 2 will be the answer. Combined leverage, contribution upon EBT. Contribution is how much? 3 lakh rupees upon 50,000. So 6. Operating leverage will be 3, financial leverage will be 2, and combined leverage will be 6. Have you got this answer? Tell me, have you got this answer? So we have completed our three types of leverage and we have done one question on each leverage. Tell me if you have any doubt. So we have done one question on combined leverage. Then we did one question on operating leverage and we did one question on that is financial leverage. So I hope it is clear to you. So in this way, the questions will come in exam. Okay, they will ask, they will give you any other value. They will change the value of in units. Sometimes they will give the value in units. You have to change it in uh, uh, per unit value. You have to change. So likewise, the questions will be framed in the exam and they will give you in such way. See, in this question, there is no need of this particular statement, but for creating a confusion, they have given this statement. You have got your interest from these two statements only, till here only, but they have given this, they have add on this statement just for making you more confused. Don't get confused, read properly the question, write the values, solve it properly, and get your correct answer. We have started module B and we have completed Unit 7, Unit 8. Two units we have completed. And those who have not watched those units, I highly request them to go and watch. All the important things are being covered in all these particular sessions. Today we have to start unit number 9 and the name of the unit is Capital Investment Decisions. So I hope everything is fine. My audibility, my visibility, please confirm me once so that we can start our today's session. So yes, what is capital budgeting? Sorry, what is capital investment? See, you need capital for your business. You need capital for expanding your business. You need capital for making different investments on different projects. You need capital for purchasing any company, for acquiring any company, for mergers, for acquisition. So you need capital for everything in your business. So capital investment means suppose you have to invest on different projects. So for every project you need capital. Now you have a limited number of capital as well. So how you will going to decide which project is good for you, which project is bad for you, so that you can make a proper investment. That is what we do different decisions on that. We use different techniques. We use different models to come to the conclusion that yes, this particular project is good for me or this particular project is not good for me. I can reject this project. So we have different decision criteria and on the basis of such criteria, we take decisions related to capital investment. Now, the goal of management is what? It is to increase the wealth of the shareholders. Again, increasing profit is another criteria, but increasing the wealth of the shareholders, it is also very crucial for any business organization because any business organization is known by its shareholders, by their shareholders. If the shareholders' wealth are good, if they have a good reputation in the market, if their market price per share is good, increasing, then definitely they have a good wealth. So we have to increase the wealth of our shareholders as we increase the profit of our company. So financial manager has to analyze every aspect, every possibilities, you can say investment possibilities to identify that this is good, this is bad, so that they can boost up the company. So we need to identify all the opportunities, the market, whatever market needs, what is the desire of the market, how much is the growth potential for in our business. So accordingly, that studying every phenomena, we identify different opportunities where we can invest, where we cannot invest. We have to evaluate certain projects also. In the coming slide, you will see that you have different techniques. You have different uh, traditional and modern methods. which you can apply on your project to know good or bad. Cost benefit analysis. It helps in comparing the expected cost against potential benefit. Whatever returns you are getting and what cost you have made in that particular project, it will help you to analyze the cost benefit. Means the cost should be less and benefit should be more, then only you can accept this project. Net present value. Net present value, it basically tells the present value of all the future cash flows. Suppose you have 100 rupees. So is the value of this 100 rupees be same after 5 years? No, it would not be same. It would be different. Clear? So what is the time value of money? So this is called what time value of money. What is the value of your money, the which you have today? What will be the value of that money in the future? So we calculate what? We calculate the present value of all the cash of all the future cash. Then internal rate of return. If you will study all these things, IRR, you will see that internal rate of return is what? The rate of return which you are getting when investing on any kind of project. So it basically tells that where your NPV is zero, that is net present value when it comes to zero, that is the position where you are getting your IRR. Payback period is what? It tells you that lower the better. The criteria for this is lower the better. You have invested 1 lakh rupees in 2020. Now, how much time it will take to recover your initial cost? That is the payback period. The least the time it will take, the good the payback is. That is lower the better. If you will get this 1 lakh rupees on 2024, means after 4 years. And if you are getting this 1 lakh rupees in 2022, after 2 years. So which one is good for you? Again, the second one is good for you. Why? Because it means uh, the soon you are getting your money back, that is the best, that is the comparatively better criteria for payback period. That is why the decision criteria for this is what? Lower the better. As soon as you recover your invested amount, that would be more good. Then financing the investment. How much you have cash in your hand? Okay, how much you will take the help of debt, how much you will take the help of equity, how much you will take the help of your internal accruals. So that is financing the investment. Third is risk assessment. Yes, whenever we take any kind of project, we invest, we need to assess all the risk related to that project. How much risky that project is, what are the things that are required to minimize the risk. So, potential risk associated with the project, you need to assess that. Then at last, you need to monitor and evaluation that the performance of the company. So, this is what? This is cash inflow after tax. So for every project, you need to calculate either CFAT or you need to calculate either PAT. Here, see, if you will see this, we have two types of capital budget techniques. The one is traditional, the next is modern. In traditional, we have two: payback period and accounting rate of return, whereas in modern, we have four. Except this ARR, this follows which kind of cash flow? CFAT. All this follows the cash flow CFAT, that is cash flow after tax. Whereas the average rate of return, this is the only method which follows the cash flows, that is PAT, profit after tax. And what is one thing that differentiates from CFAT and PAT? That is that one element is depreciation. Clear? Now, if you need to find the CFAT, so how you will going to find? We have seen in our income statement that if you will deduct variable cost, you will contribution will be there. Then deduct fixed cost, what is coming? Then EBT, that is earning before tax. But it is being assumed that in this earning before tax, the fixed cost and depreciation has already been deducted. After that, we will deduct tax to get earnings after tax, or you can say profit after tax. And this is the tax and this is the profit which AR follows. But if PAT is given and we have to calculate like NPV, we have to calculate IRR method, we have to calculate profitability index, what kind of cash flow we need for this cash flow after tax? Because just now we have studied that all of these methods will consider CFAT except ARR. So what you have to do in this case, if PAT is given to you, simply add depreciation. If you will add depreciation, we have deducted depreciation over here, and we will again add the depreciation. Why? Because this is non-cash item. This will not going to affect the economic condition of the financial condition of the company, because it is your non-cash item. It is, you are using the machines, and the value which you have depreciated, that is a non-cash item that cannot be measured in terms of cash. So again, add depreciation to get your answer CFAT, that is cash inflow after tax. If CFAT is given and you have to find ARR method, what you will do? Simply you will deduct the depreciation. You will get from PAT to CFAT, simply add depreciation, and from CFAT to PAT, simply deduct depreciation to get PAT. Done. This was comparatively very easy. Now, so we have two methods. We have seen the traditional, it is called old methods, and the modern, these are known as new methods. Now, the what is payback period? Payback period, we have seen that payback period is the time it takes for an investment to generate cash flow sufficient to recover its initial cost. The amount which you have invested, after how much time you will be getting back the investment, the invested amount, that is the payback period. You have invested 1 lakh rupees. After how many years will you will be getting back this 1 lakh rupees? That is payback period. So this payback period, this does not considers the time value of money. That is, it disregards the time value of money. This is the disadvantage of payback period. Now, what is the formula of payback period? That is initial investment. The initial investment which you have made, suppose you have made 1 lakh rupees, and all of your cash inflows, the amount which you have got back in every year, that is cash inflows, the amount which you are getting back. That is the formula of payback. Okay, let's do one question. It will be more clear to you all. So this is the cash inflows, means the when money comes back. When money comes back, that is cash inflow. And cash outflow, when money goes out. So this is the practical question on payback period. And what is the decision criteria of payback period is what? We have seen the decision criteria is what? It is very important. I am highlighting it in the box. Lower the better. This is the decision criteria of payback period. Now, the question is given to you on payback period. First of all, write the formula of payback period. What is the formula of payback period? Original cost of the asset or initial investment upon cash inflows. Write the formula initial investment upon cash inflows, not outflows, cash inflows. Suppose project cost rupees 20 lakh rupees. Project value is given how much? 20 lakh. And yield annually a profit of 3 lakh. Means profit before tax is given how much? Profit is given. It is given 3 lakh rupees. After depreciation, means it is given after depreciation at 10%, that is straight line method. It means that every year you have to deduct the same value from your asset. That is what the straight line method means. But before tax, it is given after depreciation, but before tax. It means depreciation is already been what? It is already been deducted. So what you have to do? You simply have to add the depreciation afterwards. We have seen now over here. First it is being deducted, then it is being added. It is given that it has been considered the profit after depreciation. Tax is how much? 50%. So less tax as from the income statement. 50% means 1,50,000. What will be the result? That is 1 lakh. Just a minute. Okay, 1,50,000. Great. So this is what? This is profit after tax. Now, If we want to calculate ARR, we can consider this profit, but we have to calculate which method? We have to calculate the payback method. So simply we have to, if we have to calculate this method, we want our cash flow after tax. How cash flow after tax we will get? Simply if we add the depreciation. That is 10% depreciation. 10% depreciation of 20 lakh rupees, because the costing is given how much? 20 lakh rupees. So it would be 2 lakh. Simply what you are getting, 3,50,000. That is CFAT, or you can say total cash inflow. Put the value, put all the value in this particular formula. Payback period, initial investment is how much? 20 lakhs. 20 lakh rupees. Now, cash inflows is your 3 lakh 50, means every year you are getting back how much money you have invested, 20 lakh rupees, and every year you are getting back 3 lakh 50,000. So if you will calculate this, you will be getting 5.71 years. It means I will get my money 5 years and 0.71 months. No. How to calculate this 0.71 months, 5 years, 5.1 year? How to know that exact how much, after how much months you will be recovering your money? So simply what you have to do is, for calculating in months, what you have to do, simply it is given 5.71. This is ones value, this is tens value. As we have studied in our fundamental of maths, deduct 5, because on tens place 5 value is given, deduct 5, 0.71. Then we know that in between 5 to 6 years I will be recovering my money, but exactly how much months, how much days, I don't. So what I will do, I will take that, I have to calculate the months. Simply whatever amount comes, multiply it by 12. 0.71 into 12. You will be getting 8 point. It means 8 months. So we can say that 5 years plus 8 months, or 5 years, 8 months. This is the payback period. In 5 year and after 8 months, I'm getting back my 20 lakh. I hope this question is clear to you. It was very interesting question. Now let's move to the next method, that is ARR method. So what is ARR method? ARR method, what it says that this method basically tells the average rate of return, or it is also known as what? Counting rate of return. The name of this method is average rate of return or accounting rate of return. So we can say, we can call by both of the names. Done. Now, the accounting rate of return, what it is, again a financial metric, or you can say a financial ratio. It is financial metric that measures what? The average annual profit. It helps in measuring what? Average annual profit of an investment relative to its initial cost. Which cost? Initial cost. It is basically divided by the average annual profit and the cost of the investment. Accounting rate of return is also known as average rate of return. It is a financial ratio used in capital budgeting. The ratio do not take into account the concept of time value of money. So this particular account does not take into consideration what? Time value of money. That is why we uh, calculate what? PAT in such cases. And what is the formula? The formula is average PAT upon average investment into 100. This is the formula of accounting rate of return. Am I clear with this formula? Tell me, any doubt, anyone in this particular formula? Okay, now let's do one question. Okay, Suppose you have to calculate average rate of return. Initial investment is given how much? 10 lakh rupees. CFAT is given how much? 2 lakh 20,000. Depreciation is given 20,000. Life is given, total life is given 10 years. Scrap value is given 1 lakh. Now, from all this information, we have to calculate ARR, accounting rate of return. We know the formula. What is average PAT upon average investment into 100? First, we have to find what? We have to find average PAT. We know that CFAT is given, and if we have to find the PAT, what we do? We simply deduct depreciation. So if you will deduct depreciation from 2 lakh 20,000, 20,000 from 2 lakh 20,000, you will be getting 2 lakh rupees. This is what? This is simply PAT. So you have got what? You have got your average. Now, average investment means what? Average means what? Opening plus closing divided by 2. So here opening balance is given. Initial investment is how much? 10 lakh plus. Closing is what? Whenever in the question it is written like scrap value, okay, residual value, final value, closing investment. So all these are what? The closing balance. So how much scrap value is given? That is 1 lakh rupees upon 2. Simply 11 lakh divided by 2 is how much? 5.5. So we have got what? We have got our average investment also and the average part also. So this is given in average. So average part is 2 lakh and average investment is how much? 5 lakh 50,000. Simply put the value 2 lakh upon 5 lakh 50,000 into 100. If you will calculate this, what answer you will get? You will get 36.36%. So this is what? This is average rate of return. Done this question. So we have found what? Average rate of return, or you can say accounting rate of return. This is how we will calculate our average rate of return. So if the closing balance given scrap value, residual value, final value, closing investment. So all these are what? All these are your closing balance. Done this question. Now, let's move to the next question, that is net present value. So what is net present value? Again, it is the difference between present value of cash inflows minus present value of cash outflows. This is the difference between the present value of cash inflows and outflows, the net present value. This value considers what? The first is the formula. Second is this value considers the time value of money. Okay. It is again a type of financial metric to calculate which project is good, which project is bad, to come to a particular decision criteria. It reflects what? Value today of future cash means present value of all the future cash flows. It indicates that. It is again a very important decision tool of investment, and it considers what? NPV accounts for time value of money, that a dollar today is worth more important than a dollar in the future. Because whatever you are earning today, the same value if you will earn after few time, that will be not worthy enough. So 100 rupees, the value of 100 rupees now is greater than the value of 100 rupees after few years. This is what? This is time value of money. And what is the decision criteria? This is what? This is the decision criteria. Yeah. So decision criteria is what? Whenever any project If the NPV of that project is greater than the zero, then you will accept that project. If NPV of that project is equal to zero, then it is neutral. It depends on an investor either to accept or to reject. When NPV is less than zero, simply reject the project. Suppose you have, let's take an example, project 1, project 2, project 3. You have invested 100 rupees in project 2 and you are getting 100 rupees. You are investing 100 rupees in project 1 and you are getting 105 rupees in return. You are investing 100 rupees in project 3 and you are getting 98 rupees back. Now tell me which project will you going to choose and which project will you going to reject in this particular case? Tell me. Tell me. So yes, definitely you will going to select this project because you are investing the amount and you are getting back more amount. So you will going to accept this particular project. It depends on you that whether you will going to invest or not because you are getting the same return if you are investing. And in this particular project, you know that you are investing rupees 100 and you are getting a loss of rupee 2. That is, you are getting back 98 rupees. So NPV when it is greater than 0, you will going to accept. Okay, if it is greater than 0, we take the decision criteria as 0. If it is equal to 0 means you are investing 100 and you are getting back 100, then it is neutral. You either you can accept it or you can reject it. If NPV is less than 0, either you have to reject that project, otherwise you will be getting lost. This is the decision criteria of the project of NPV, net present value. Here, okay, chalo, let's do one question. Compute the net present value for a project with net initial investment of 1 lakh rupees. The net cash flow for 1 year is 55,000. For 2 years, for second year is 80,000. For third year is 15,000. Further, company's cost of capital. What is this cost of capital? Can anybody tell me? This cost of capital is what? Discounting factor. Discounting factor means this factor will tell you the present value of all the cash inflows in the future. Present value interest factor. PVIF present value interest factor at 10%. That is cost of capital is what? 10%. Now, for 3 years are given to you. Suppose the value for 3 years discounting is given to you. But if the value is not given to you, how you will going to calculate this? Okay, how you will going to calculate the 10%? That is simply what you have to do. You have to do 1 upon 1 plus R upon N. That is 1 upon 1 plus 10%. That is 1 upon 1.10. Simply 10% is what? 1 upon 1.10. If it is given 20%, what would be that? 1 upon 1.20. 18% will be there, then 1 upon 1.18. So like this, we have to calculate. We have to do equal to, then m plus equal to m plus. So suppose you have given for 3 years discounting. If you will do this 1 upon 1.10, you will get 0.909. In 0.909, after 0.909, just do equal to, you will be getting 0.826, equal to 0.751, equal to, and in the same manner, you will get every year the discounting factor. This is how we calculate discounting. Although it is given in this question, but in your exam, sometimes this will not be there, then how you can calculate this? Okay. So this is given in the book. That is why, or else in the exam, you will be given only the discounting factor. So this is how we calculate the discounting. Now, how we calculate the present value? Okay, NPV. That is write all the years over here. Then write net cash flow. Then what, right? What is PV factor? PV at the rate 10%. After this, what you have to write, the after this, the discounted cash flow, what you get, you have to write that. Now, so we have 0 year. In the 0 year, you have invested how much? 1 lakh rupees. So you have invested, the cash outflow is there, write in negative. Then for third year, till third year, I have given the value. That is, in first year, I'm getting how much money back? 55,000. Then second year, 80,000. Third year, 15,000. Present value at 10%. That is discounting. What is the value given of discounting? 0. This would be what? This would be 1 because no value is given. So it would be nothing. For first year, it is given 0.909. For second year, 0.826. For third year, 0.751. Clear? No. If you will do cross multiplication, it will come like this only. 1 lakh. 55,000 into 0.909. How much is the value? What is will be the value? That is 4,995. Do multiply 80,000 into 0.826. So what will be the value? That is 66,080. 15,000 into 0.751. Okay. What would be the value? Tell me. Quickly tell me what would be the value. I'm waiting. It would be 11,265. Now, now consider all these things. Add these three items and deduct from 1 lakh. So what value you will get? After this, what value you will get? In actual, you will be getting 27.7, sorry, 340. Let me do the cross. Let me do it. 1 lakh 4,995 plus 66,080 plus 11,265. Then deduct 1 lakh. That is the actual NPV, the discounting after discounting. What value I get NPV? That is 27 lakh 340. Am I clear with this question? Tell me. So you have invested 1 lakh rupees in first year, you have got 55, second year 80, third year 15,000. So actual value which is left for you after discounting, that is 27,340. So this is what? This is the actual net present value. Then if you have any doubt, then ask me. If you will add these all three, then what answer you will get? If you will add all these things, you will be getting 127,340. Deduct the invested amount, 1 lakh. How much you will get? 2740. This is present NPV. Here, any doubt to anyone in this question? Now next. Next is profitability index. Profitability index, it basically tells the relation between the cost and the benefit of the product. How much you have invested and in return how much you are getting, that tells the relation between these two under profitability index. This is an index that either experience or represents what? The relationship between the cost and benefit of the project. It is also called value investment ratio, very important, or profit investment ratio. We provide ranks to the project in accordance with their profitability. So profitability index, the formula is present value of future cash inflows by initial investment. This is what? This is the formula of profitability index. Clear? Everybody tell me. the formula of this profitability index. Okay. So I'm giving you one question. Solve the question this, or you can also say profitability index of cash inflow upon profitability index of cash outflow. Now, if profitability index is greater than 1, then accept the project. If it is less than 1, reject the project. If it is equal to 1, you are indifferent, means you are neutral. Either you will accept it or you will reject it. Suppose we have three projects A, B, and C. One is giving 1.1, another one is getting 0.8, another one is getting 1.4. So which project you will going to accept? You will going to accept 1.4. And on the basis of such factors, you can also give them the rank. What rank? Suppose you are getting in these two project A and C more than one. So first of all, which project you will choose? First rank you will give to project C 1.4. Then at second you will keep your project A, that is 1.1. So you can give the rank according to it. Now this is the question. Take the screenshot of the question and comment your answers below. The profitability index of all these three projects. Profitability index 1, 2, and 3. So we have three projects. This one, this one, this one. And the inflows are given for project 1, 6,50,000, project 2, 95,000, and project 3, 1 crore 30,000. Simply you have to put the factor inflow upon outflow, inflow upon outflow, inflow upon outflow. What is the inflow in the first one? 6,50,000 upon 5,50,000. In the same manner, the second one is 95,000 inflow is given and outflow is given 75,000. So we have three projects. Discounted cash outflow is given for every project and inflow is given for every project. Similarly, in project 3, 1 crore 30,000 upon 1 crore 20,000. Calculate and please comment me your answers and also tell me that which project will you going to choose and give the rank accordingly. How you will rank your projects. Okay, I will wait for your answers in the comment section box. So please tell me your answers over there. I hope you have enjoyed today's session. We have completed few methods also of our capital budgeting and we have done its practical problems. The most important questions, they definitely come from all these units, from all these topics. Let's meet tomorrow with another session and please confirm me the answers. Write down in the comment section box which project, for project like this is project 1, this is project 2, this is project 3. Comment down your answers below and also tell me that how you would going to give them rank. Which project you will going to choose first, which project you will going to choose later on. Well, then we'll meet you tomorrow. Okay. So till then, take care everyone. Goodbye. And if you feel that these sessions are helpful to you, then kindly like the sessions and share it with others as well. Okay. Bye then. Take care everyone. We did what is capital budgeting. Then we have done various methods like ARR, average rate of return, then NPV, then profitability index, okay, IRR. So we have done all these methods and we have done one practical questions of each method, ARR, NPV, and profitability index. That so these were the most important concept that every time they do repeat. Every time questions definitely come from all these sections, from all these topics. So we are here to cover only the important concepts. Now, in today's session, see unit number 9, unit number 10, and unit number 11. All these units are interrelated to each other. That is, all these units are of capital budgeting. Just the difference is of In unit 9, what we have studied that how we will going to decide when we are opting any kind of investment, when we are selecting any kind of project for investment. So what are the decision criteria that we have to keep in mind, how we will going to select that project on the basis of some decisions. In unit 10, what we will going to study over here, that if we want to invest in any foreign in countries project, like in unit 9 we have invested in Indian project, but if we want to invest in any foreign project, then what are the decision criteria? Okay, how we will going to invest, because the currency is different. In our uh, in India, the currency is in rupees, and in foreign country, the currency may be according to that country, maybe in euro, maybe in dollar, maybe in yen, okay, maybe in British pound sterling. So whatever the country is according to that country's currency, we have to invest, we have to do the investment. So in this particular unit, we are targeting what capital budgeting for international project investment decisions. How we will going to take the investment decisions when we are investing in internationally, when we are investing in international projects. So what we have studied in unit 9, everything is same, done. Every method will be same, everything, every calculation will be same. Just the difference is of one thing, and the difference is of the currency value, the value of currency, the exchange rate of currency, the spot rate. Okay, so these things will only differ from unit 9, else everything will be same. Now, so let's move to the unit. So, what are the ways, methods, discounting techniques? Everything will be same except the one thing, that will be the currency. If the project is given, if you are investing in international projects, so currency of that country will be dollar, euro. So what you have to do, you have to do the you have to multiply after getting the proper decision, okay, criteria. After analyzing all the projects, what you have to do, you have to multiply that amount with the exchange rate of your country, then you can get the value, the proper value of your country. So first you have to, if you want to invest in any foreign countries project, then you have to exchange your rate, exchange the rate of your country, okay, according to that project, or and vice versa. So cash flows are either they will be converted in home country's currency, or they would be converted in foreign country's currency. So what are the considerations that we have to keep in mind? Foreign and home currency cash flows. So cash flows, either they will be given in foreign currency or they will be given in home currency. So what you have to do, you have to change accordingly that all the cash flows. When dealing with foreign and home currency cash flows, there are several considerations that we have to keep in mind. The first is exchange rate fluctuation. Yes, definitely. In our country, there are every day, every week, every month, there are fluctuations happening. So definitely the exchange rate will also fluctuate in our country as well as in their country. So exchange rate fluctuation, this is the first point that we have to keep in mind. And with this exchange rate fluctuation, what happens? Your cash flow will also change. There will be a impact on your cash flows. So they do change. Cash flows in foreign currencies are subject to exchange rate risk. As the exchange rate increases, decreases, according to that, the cash flows increases or decreases. So which can affect the value of cash flows when converted to home country, home currency. Now, inflation differences, again, inflation, if there is high inflation, then definitely the exchange rate, the currency rate according to that country will be high. Okay, so inflation differences, this is the second phenomena that we have to keep in mind. We have to do the analysis of this while investing in any foreign country. So they will also impact what? Our cash flows. Inflation rates can differ between countries, impacting real cash flows. When investing, when you are investing, then you have to keep in mind all the evaluations, all the analysis. According to that, risk will also come. You have to adjust the risk. So it is not very easy to invest in any foreign country's project. You have to study the whole market. You have to study the whole risk phenomena. if any risk is coming, what are the techniques you will do for minimizing those risks. So definitely there will be a lot of things coming into your way when you are investing in any foreign country. And foreign currency discount rate computation, that is what converting local currency into foreign currency is done at a prevailing rate, which is called spot rate. So what is spot rate? Suppose today is 14th Jan 2025. So on this particular day, you are investing in any foreign country's project. Now, on this day, what is the current market price prevailing in that country? On this date, what is the current market price prevailing in that country? For example, let's take an example for today. Okay, as of 14th Jan 2025, $1 equals to 85 rupees. So you are investing today. So what $1 will cost rupees 85 rupees. Now, suppose if you are investing after 2 months, like you are investing on 14th March. Now, what is the current prevailing rate in that country? Let's take an example. $1 it becomes 87 rupees. So this is the spot rate that is done at the prevailing rate, which is called spot rate. So this is the rate which is prevailing in the country, in the foreign country. That rate is known as spot rate. Am I clear with this important topic? Now next. Okay. So yes. Now, direct and indirect channels for international investment. Okay. So it basically tells ways to invest in international market. Okay. So directly invest in domestic country. If you are domestically, we have different channels, different ways for investing. We have direct equity, we have equity, just mutual funds, debt mutual funds, NPS, PPF, bank, SCS. So these are all of domestic, that is of our country. Internationally, what we have American depository receipts, that is known as ADRs and GDRs. Global depository receipts, foreign direct investing, global mutual. So all these are related to what? These are related to internationally. So there are different ways to invest in international market. Directly, we have these type of elements, and internationally we have such kinds of elements. Now, what is ADR and what is GDR? See, every country has their own depository receipts. Suppose I have purchased goods from your country. Now, so how you will going to know that I will give you the money or not? You don't have faith in me because we don't know each other. But due to globalization, we are building what? Trade and commerce. So how would a buyer, how would a seller know that I will pay the money to him or not? So for this scenario, what we have depository receipts in every country. So there are ADRs and GDRs. GDR is what? When an when an Indian company raises funds from international market, then by selling their, you can say by selling their equity, by selling shares, then it is known as global depository receipt. Clear? Now, when an Indian company raises funds from America, when an Indian company raises funds from America, then it is called what? American depository receipts. And they can raise funds with the help of equity, shares. Okay. So this is what ADR and GDR. No. Multinational corporations, in case of indirect channel, the investment is made into certain intermediary mutual funds who in turn invest into various sectors. So what we have different indirect channels as well. These are what? These all are the direct channels. Now, what is an indirect channel? Suppose, let's take an example. This is an Indian investor. Okay, here is an one Indian investor. Now, this Indian investor, this Indian investor in investing in the mutual funds, and this mutual fund is Indian mutual funds. Now, this particular mutual fund, what this mutual fund will do, this fund will invest in any other mutual fund which is situated in any foreign country, which is situated in any foreign company. So this is what my money which I'm investing in this mutual fund, this money is being transmitted to this particular mutual fund which is situated where in any foreign country. So this is an indirect channel example. I have invested in Indian mutual funds. Now this Indian mutual funds are investing in different countries mutual funds. So this is an indirect channel. Here, tell me, any doubt to anyone? Okay, sure. So this we have done. Now, what are the returns and risks if you are investing in any, if you are making an investment in any foreign country? So definitely, if there are high returns, if the risk is high, then definitely the returns will also be high. Or if you are expecting high returns, then you have to bear high risk because if risk and return, so both go in a same direction. Now, what are the potential returns? Returns means the profits of foreign investment. So, what are the profits of foreign investment? The first is diversification. Yes, if you are investing in different projects of foreign country, so the risk will what? The risk will diversify. Suppose from this project you are not getting a good return. From this project you are not getting a good return. But from this project you will definitely get a good return. So it is not possible that wherever you are applying, wherever you are investing, every project will give you a negative returns. No. There might be some projects which will give you negative return, but most of the project they will give you positive return because you have analyzed those projects, you have studied properly, then only you have invested now. So the diversification of risk, risk is diversified. That is risk. There are chances of less risky projects. Growth opportunities, yes, definitely. If we are investing in any foreign country, so returns will be high because the rate, according to the rate of that country, we are getting the return. So our country's money is less than the foreign country's currency. So growth, there will be growth opportunity. Then currency appreciation, yes, again, if there is a proper growth, we know that we are doing a good business. Everybody is knowing us. We have a business in India and our business, and most of the people will know in foreign country our business because we have invested in their company. So with this, what happens? The if the opportunity of growth increases, then definitely the currency value also increases. That is appreciated. Appreciated means it increases. Access to different industries, yes, we can have the access to different industries, working with them, okay, investing in their projects. We will see how they are uh, running their business, what are their agenda, so everything we can know. And higher yield means the high profit. So these are the good returns from making an investment in foreign country. Definitely if there are returns, then you have to bear risk as well. So, what are the risk of foreign investment? The first is currency risk because the fluctuation, the market condition you need to study. Then political and economic risk. Yes, there may be political intervention more might be in some countries. Economic risk will be there. The fluctuations of the currency rate, inflation, deflation. Market risk, the market risk according, you have to study the whole market properly. You have to do the proper analysis. So for these things, you need time also. You need money also. You have to give more effort also. Cultural and operational risk. Yes, you have different culture in your India. In some other country, they have might be having different culture. Operational risk is what? The failure of system. The failure of system. Operational risk will include such kind of things like system has been failed, okay, not the proper discounting is not done. So these are the things which are included in operational risk. So risk will come. If there are high risk, then there are chances that returns will also be high. Done? Clear? Now there is one important model in this particular unit. We called it CAPM model, the capital asset pricing model. So capital asset pricing model is what? It basically tells the relation between the return and what kind of return? The expected return. The return which you are expecting from any particular project, and with the return, what else you are getting, you have to bear the risk also. So it basically describes the relation between the expected return from the project and the risk which is related to this particular return. The risk related to this particular return. Yeah, this is what the CAPM model says, capital asset pricing model. Now, it is the foundational concept in finance that establishes what? A relationship between the expected return and the risk. The returns are always based on the risk and the time value of money. So, yes, definitely, we have seen what is time value of money. We have read this in our previous chapter. The time value of money, what is discounting. So, on the basis of such factors, what happens? The risk arises. If the risks are more, according to that, to time value of money, we will be getting our returns. It is generally done for risky assets so that the price is appropriated to generate expected return. So those projects which are of very risky nature, it is basically done on that. So to know what can be the return, what can be the expected return we can get. Suppose we have invested 1 lakh rupees, and in return, I'm expecting that at least 1.2 lakh rupees I'm getting back. But the risk is very much related to this particular project. So it might happen that you may get 1.1, might happen that you may get 1.05 lakh. So according to the risk, your return determines according to the risk of the project. Yeah. So its formula is RE is equal to RF. RF is what? Risk-free rate. Okay. Beta is what? Beta is levered risk. The levered risk is beta. Okay, let me write this page. See, what is the formula of CAPM model? It is RF plus beta RM minus RF. This is the formula. Now, RF is what? RF is risk-free rate. Beta is the levered beta, means the risk. RM is what? Expected return. Expected return on the market. Expected return which you are expecting from the project. RF is again same, the risk-free rate. Here, and RE is what? It is cost of equity. Now, based on this, okay, formula is what? Formula is given to you this one. I'm giving you one question. Please solve and tell me what is the answer of this particular question. I hope you have calculator with you. No. Suppose in the question RM is given 16%. Very easy question I'm giving you. RF is given 8%. Beta is 1.4. Now you have to find what? RE. RE is what? So RE is equal to, this is the formula. Put all the values on this formula and tell me what should be the answer. The formula is what? RE is equal to RF plus beta RM minus RM. RF is how much? RF is 8% plus beta is 1.45. Now RM minus RF. So 16% minus 8% is how much? Again 8%. So it is 8%. So with the BODMAS rule, what you have to do? First, you have to multiply this 1.45 into 8%. How much it will come? 11.6%. That is 19.6% is the answer. I hope this is clear to you. So this is what our cost of equity from the CAPM model. Now, next is arbitrage price theory. The arbitrage pricing theory, this is one level up of CAPM model. In CAPM model, what we see the relation between the expected market return and the risk associated with it. Now, arbitrage pricing theory, what it tells that basically the arbitragers, how they get the advantage of any project from the, you can say, from the mispriced securities. Okay, let's have a very, very basic example. Like suppose I have purchased goods for rupees 100. Okay, I have purchased goods for rupees 100 from ABC ABC Limited. Here now, I have purchased goods of rupees 100 from ABC Limited. Let's take an example of you can say, okay, mobile cover 1000. Now I have purchased this. Now I am selling the same mobile cover to another shop, PQR Limited, for rupees. Simultaneously, I know that the price of mobile cover in this particular shop is, every shop is every mobile cover worth rupees 1200. So I will purchase from any particular shop, that is ABC, and I am going to sell this mobile cover to this new shop, that is PQR Limited. So how much I am getting a profit? I am getting a profit of rupees 200. I know that here the price is less, and in this shop the price of mobile cover is very high. So I will purchase the price at low prices from this shop, and I will sell to this particular shop at high prices. So the difference between two prices is what my profit is. So this is called the arbitrage. Arbitrage means simultaneously, if you are doing purchasing and selling simultaneously, that is arbitrage. It is a multi-factor model that provides an alternative to CAPM model. CAPM, it includes returns, market returns, and risk. Whereas this method of theory goes beyond it, means one level up, thinking that markets sometimes misprice the securities. So when we know that, suppose in this case, for a certain day the price gets 1200. Rest of the time the price is, you can say, a very cheap. But certain day the price gets very high, like for like on the eve of New Year, on the eve of, you can say, Christmas. Okay, on the eve of festivals, what happens? They increase their prices. All shops will decrease their price, but they increase their price for some reason, for might be some of the reason. So what happens? The mispriced securities, from this they will earn their money. That is called arbitrage. And who does this kind of job? Arbitrages. And they have their core product. That is why they are increasing their prices. So this basically happens in case of shares, when the market fluctuation happens in securities, because the security shares prices goes up and down. I am giving you this just a basic example. So let's do this question. This is the question of what? From arbitrage pricing theory. What you have to do, for example, the following four factors have been identified as explaining a stock's return and sensitivity to each factor and the risk premium. So in every statement, you will be getting one risk premium. Risk premium is what? I know that this particular uh, thing is very risky, like GDP. It is very risky in your country. So to cover risk, what country gives? The country gives the risk premium. It gives the premium to cover the risk of that particular element, particular component. So risk premium is associated with each factor and have been calculated, means risk premiums. RP stands for what? Risk premium. Now GDP of the country is given. How much GDP is given? The beta is what? It is risk. We have studied beta is what? Risk. So it is given 0.6. Now to cover this risk, the risk premium of 4% is given. Again, inflation rate is very high in your country. So it is the risk is what 0.8, and to cover this risk premium is 2%. Now gold prices, again, the beta, that is the risk in your country, is 0.7, and it is minus. If you will see this thing, it is in minus. Risk premium, to cover this risk because it is in a negative, to cover the risk 5% is given. Now Sensex index, the beta is 1.3. It is very high. Risk is very high, 1.3. To cover this risk, 9% of the risk premium is given. Now, without risk-free interest rate is given, that how much I can earn from your from your country without facing any kind of risk, just 3%. So it is given. Now, using APT formula, arbitrage pricing theory formula, what we have to find? We have to find the expected return, and how we can calculate this. See, what value is given without a risk premium? Risk-free rate is given 3%. Simply write it 3%. Add all the sum. Why? Because we have to find the expected returns from all of the elements. Now, GDP is what? GDP is given 0.6, and to cover the risk, how much risk premium is given? 4%. Simply multiply this. Then do addition. Second is what given? 0.8 given inflation rate, and to cover this beta, this risk, how much percent risk premium is given? 2%. Simply multiply with 2. Then add gold prices. That is, it is a negative, minus 0.7 into 5%. Again plus 1.3 into 9%. If you will calculate this, you will get value 15.2%. So this is what, this is the all the factors. Okay, every, if you will calculate, if you will sum up all the factors, so what the arbitrage, what exactly the answer comes, that is 15.2%. So using arbitrage price theory, arbitrageurs can take advantage of any deviation from fair market value. So this is the fair market value, and the risk premium is given to cover the risk. So this is what, this is the premium given to cover this risk, and from this, how much percent can earn, that is 15.2%. Here, okay. Now, next, what are the approaches for evaluation of overseas project? The home country approach says what? All of the cash flows of the project, first they have to be converted into the home country. This is included under home country approach. And if we are opting for foreign country approach, so all the cash flows of the project, they will be converted into the foreign country currency approach. So there are two types of approach, and every method will same, the same NPV will be there, the same IRR will be there, payback period, average rate of return, okay, MIRR, all methods will be same, all ways will be same to calculate the proper risk, proper return of the invested projects in international country. Done. This was important. Till now, this question has not been given in the exam. So there are high chances that might they will ask this type of question. If they want to make the level of the question high, so they can ask such type of question. Okay, I hope it is being clear to you. So in such way, you can calculate all of the, you can say all of the factors, all of the components of the stock return. New topic, that is adjustment of risk and uncertainty in capital budgeting decision. So what we will going to start today is the different types of uncertainties that arise, different types of risk that arise when we select any kind of project. So when we are opting for any project, risk will also come, the uncertainties will also come. So after those all risk and uncertainties, how we will going to select our project, how we will going to make an investment, that is all about the adjustment of risk and uncertainty. After adjusting risk and uncertainty, how can we conclude our budgeting decisions? So this is what we have to study in this particular unit number 11. So I have already told you that unit 9, unit 10, unit 11. These three units are a part of what? Capital budgeting. So capital budgeting decisions, capital budgeting techniques, capital budgeting decisions in international project, or various types of risk and uncertainties that arrive. We need, after adjusting those risk and uncertainties, how we conclude our capital budgeting decision. All this we have to study today. Half of the portion we have completed 9, 10 previous sessions. I hope you have watched those sessions, and today we will start with our unit 11. So before starting, please confirm me my audibility, visibility, everything is fine, perfect. Tell me everything is fine. First one is sensitivity analysis. For analyzing risks and uncertainties in project, we use different models, we use different techniques for that, and one of them is what? Sensitivity analysis. In coming slides, we will be learning many more analysis, many more techniques for adjusting the risk and uncertainties. But today this particular slide, the first one is what? Sensitivity analysis. Now, what is sensitivity analysis? It basically tells that study of change in one element on project. It tells study of change in one element in project. See, we have different types of component in our project. We have sales also, we have variable cost also, we have interest also, we have tax also, we have different types of debt also, then we have fixed cost also. So we have different types of component when we are investing in any kind of project. Now, suppose in our business organization, suppose if we take this particular element variable cost, and if we manipulate this variable cost, means if I manipulate this variable cost to this particular element, so what will be the impact on the profitability of the project? This is what the sensitivity analysis tells. That if we make any kind of change in one variable, then what will be going to the change in other variables as well as clear profitability of the project. So this is what the sensitivity analysis tells. If we change any one variable, so what will going to be the impact in other variables and profitability of the project? Suppose if I change the tax rate, so definitely the profit, they will also change. If I change the variable cost, so definitely my contribution will change. If I change the interest, so definitely my sales will also change. So what is the impact on other variables if we change any one particular variable? Done. This is what we have to study. It studies the impact of one variable on profitability of the project. It defines or study of one variable on the profitability of the project. This is the whole crux of sensitivity on the project's profitability. Now let's read these statements. Sensitivity analysis, it is a technique used to determine how different values of an independent variable impact a particular dependent variable. The variable which we change, that becomes independent variable. We manipulate this particular variable and we see the impact on our dependent variable. The variables are important components. It might be any cost, revenue, net profit, your sales, interest, anything it might be. Sensitivity analysis aims to assess the impact of changes in one of these important variables on our projections and estimates. Whenever we have to analyze our uncertainties, our risk, so we do what we do, we study the change of one variable and we see the impact on other variables. We see the impact on the profitability of the project. We see impact on the returns of the investment. Yeah? This is what sensitivity analysis is. Now, next comes is scenario analysis. So in sensitivity analysis, we see the impact of one variable, we change one variable and we see the impact of that one variable on all other variables. In scenario analysis, what happens? We study mainly three scenarios. We take multiple variables and we put all variables in different scenarios. Three scenarios are: one is the best one is the worst one, and one is normal. Okay, so scenario analysis is what we study three scenarios in. We study three scenarios, that is best one, worst one, and normal one. We take multiple variables like we change cost also, we change net profit also. We see its impact in best version, we see the cost and net profit impact in worst version, and we see cost and net profit impact in normal version. So we take multiple variables on and we do different analysis on these three types of scenarios. That is what the scenario analysis is all about. Now, what the best one says, what the worst one says, and what the normal one says. See, the best scenario, the name of the best scenario is what? The optimistic. The another name of best scenario is optimistic. Here, worst is pessimistic, and normal is expected. Here, so we change multiple variables on these three scenarios and we see the result, what happens on our profitability of the project. What will be the worst result if so? What will be the best result if everything changes? What will be the worst result if everything changes in our organization, in our internal aspect, in our profit, in our investment, in our project? What will be the normal expected scenario if everything changes? On these three scenarios, we put all different variables and we see the impact on the profitability of the project. Am I clear with this? If there is worst scenario, how much worse I can lose? It is the best scenario, how much good I can earn. If it is a normal scenario, how much average the return I can earn from any particular investment. That is what the scenario. And remember the other name as well. Best is optimistic. This is best. This is normal. And this is pessimistic. Tell me, am I clear with this? Okay. Now, optimistic, it assumes the best case scenario that issues will not occur. Most likely, these are what the expected. And the other name of expected is what? The normal. It assumes some issues might occur and based on how long the task usually takes under controlled circumstances. If everything is normal, if everything is going in a proper way, then how much I can earn from this project, how much I can lose from this project. That is the expected and normal. And pessimistic is the worst case. If the demand changes, if the supply changes, okay, if market fluctuations occur, if market condition changes, so what is the case in worst case scenario? See, I much how I much how much I can lose from that project. This is the scenario of pessimistic. As you can see over here, see, pessimistic, in expected, and optimistic. See, investments are pessimistic is what? It is very poor. Expected is it is average, and you can also say normal. And optimistic is what? It is the best one. So I have made an investment of 48,000. Now, sales are very less. I have invested 48,000, but the sales are only 30,000. Now, variable cost is what? Variable cost is also comparatively low. The fixed cost is will be high. Depreciation is 4,800. Tax profit comes 1,600. Profit after tax is 1,060. And annual cash flow from operation is what? That is 5,860. Why? This is what? This is CFAT. CFAT, when you add depreciation, 1,060, when you add depreciation, that is 4,800, then you will get CFAT. So I have told you the concept of PAT and CFAT. So if the scenario is worst, if the scenario is very poor, so you are how much you are earning after applying net present value, that is a negative 14,900. When the scenario is normal, means in you have invested 48,000 and every year you are getting a loss of 14,900. This is a poor scenario case. Expected scenario, every year you have invested 40,000. Accordingly, sales are comparatively better from pessimistic scenario. You are earning at the end of the year 5,200. Now, in optimistic scenario, you have invested 36,000 and sales are very high. As you can see, from 36 to 42, the sales are very high and you are getting every year how much you are earning from the project. That is 10,080. So it is the good one, it is the normal one, it is the worst one. So this is how we see, in the tabular form, we see how much return I'm getting back, how much profit I'm making. Now, next is what? Next is a Hillier model. So Hillier's model is one amongst many of these risk analysis techniques. So as the other risk analysis technique we have seen, what? The first is sensitivity analysis. The second is scenario analysis. In sensitivity analysis, we have seen that we change one variable and we see the impact on other variables as well as the profitability of the project. In scenario analysis, we change multiple variables and we change this multiple variables in three scenarios, in three different scenarios. That is what we have studied: the good one, the best one, and the worst. Clear? So in these two models, we have studied this. Now, next is what? Next is Hillier model. So what this Hillier model says that basically this Hillier model is also one of the techniques for analyzing the risk and opportunities of the project. So Hillier model, it is also based on NPV like earlier methods. So let me tell you that the earlier both the methods are scenario and sensitivity analysis. Okay, these two methods are based on NPV or IRR. Similarly, Hillier's model is also based on NPV like earlier methods. So this for risk analysis, this method makes the base what? Makes the base of NPV. Now, it is in this risk is represented by what? It is represented by standard deviation, ST. And the symbol of standard deviation is like this, and you can also say a sigma. So remember the name and the symbol of standard deviation. So on different situations, we calculate NPV in Hillier model. Then after calculating, we plot it on the graph. That is, it is done in the graphical representation is done. So we plot on the graph, the graphical representation is done. It mainly says that if the standard deviation, if the deviation of cash flows is less from the mean value, then the risk will also be less. That is, if standard deviation from mean value is less, then risk will also be lesser would be the risk. And if the standard deviation from mean value is high, then risk will also be high. This is the concept of Hillier model. Very important. It means it has a relation, a linear relation. You can say a positive relation or a direct relation between standard deviation and risk. So this is all about Hillier model, and no practical questions come from this particular topic. Only the theory will be. So what things you need to make clear in your mind that it makes the base NPV Hillier model. It is denoted by risk is represented by standard deviation sigma. It tells the relation between standard deviation and risk. standard deviation from mean is less, then the risk will also be less. Standard deviation from mean is high, then the risk will also be high. So there is a linear, positive, and direct relation between standard deviation and risk. And after analyzing the risk, then it is being plotted on a graph, that is in a graphical representation. And then we make decision regarding the investment, whether to invest that or whether to reject that particular project. I hope this Hillian model is clear to you. Okay. Now, next topic is decision tree. So as you can see the image, this is a tree. Decision means what? The correct analysis, the correct decisions which you make for your project, that is the decision tree. So decision tree helps an investor to decide in which project to invest. Risks and uncertainties will be plotted on a graph. It is a technique that is being, it helps to study the project and makes decision. With the help of this, if you will plot everything on graph, so it is easy for an investor to make a, it is easy for an investor to decide that which project is good for him. And if you, whatever you see as visualization, it will retain in your mind for a longer period of time rather than if you write in your notebook. So that is why decision tree is helpful for an investor to make the correct decision for their project. Done? So let's have an example of this. See, let's take an example. This is the owner of ABC. Now, this owner, he wants to, he's mainly his business deals on product. Okay, let's take cosmetics. Now, this particular owner, okay, wants to launch any new product in the market. So what would be the strategy for launching the product in the market? First, product launch strategy. First, he will think that, okay, let's launch the product without testing. If no testing is done and market testing is done. So if market testing is done, then there is 65% chances that it might be positive, and there are 35% chances that it might be negative for your business. Now, without testing, if you are launching a product, so only 30% is the chance that you can successfully launch the product. Rest 40 and 30% are the chances that you can, there is being a failure of the product. Like you will get a success only a little bit success, and 30% chances that your product might fall. Now, in market testing, if you have 65% positivity, so there are again in from 65% you have chances of 60% that your product will successfully launch in the market. You have chances of 30% that it may successfully launch and it may successfully fall also. So it is in the in between, like little bit success. Now, failure, so there are 10% chances that the product may fail. Now, if you have done the market testing, but the result from the consumers, they came in a negative way. Okay, the negative impact mainly comes from the market testing. So still there are 10% chances that the product may get successfully launched. 20% are the chances that you will get only little bit success, and more percentage is the chance of the failure of the product. Because why? Because the market testing has gone negative. Now, if you will see this, okay, you will see this whole chart. With this chart, you can easily analyze, by seeing this whole chart, you can easily make a decision that yes, it is good for me to launch the product without with that is with testing. I have a chances of 60%, at least minimum 60%, I'll be getting a positive return, rather than here are chances of only 30% of positive return, and here are chances of 60% of positive return. So with this particular chart, with this graphical representation, any investor, any businessman can easily decide, can easily make a decision for any product, for any investment, for any particular capital investment. Okay. So that is why decision tree model is very important for any businessman, any investor. No. Next topic is corporate risk analysis. So yes, see, it is not every time possible that you are selecting a project so that the risk is associated with the project only. There are risks in your, maybe in your internal matters also, in your internal companies also, in your corporate sectors also. So there are chances that that risk may arise from that aspect also. Not 100% the risk arises from any particular project. Okay, in any project which where you are investing. Risk may also arise from your corporate sector also, from your business also. So risk analysis in corporate sector, it is the process about identifying the risk. Once you have identified the risk, you will assess it. You will try to minimize the risk. You will try to manage the risk with your risk, with the help of your risk managers, so that you can achieve your objectives, the targets in a very good manner. Now, first, what an owner, the top level has to identify the risk. After identifying the risk, you need to identify the risk in your internal matters also, in your external also. In internal, what thing you can keep in mind, like operational failures. Operational failures means the failure of your system, failure of your manpower, the failure of your machines. So this is what the operational failures. Employee turnover means when employee gets absent a lot. That is employee turnover. Now, external failure is what? Market fluctuations. That is inflation, deflation, recession, regulatory changes. Every time the law gets changed. So that all comes under where? The risk identification. So first, it is important to identify the risk from where the risk is coming. Either from internal sector it is coming, or from the externally it is coming. After identifying, assess the risk, that is how much that risk is impactful. Okay, how that risk is impacting our business. Are the risk is impacting our quantitative method, or it is impacting our qualitative methods? So based on that, okay, you need to assess the risk. After assess, you have to use different techniques, different models to lessen the risk. To lessen the risk means to mitigate the risk, that is to reduce the risk. So with the help of techniques, different policies, different methods, we can reduce the risk. After that, once risk has been reduced, so again you have to monitor and report everything. Okay, regular reporting has to be given to the shareholders, is to be shared with all the members of the company, ensuring the transparency and accountability in the business organization. Clear? So we have done some important concept of our uncertainties and risk analysis, the simulation analysis, the scenario analysis, the Hillier model, and decision tree. So these four are very important, and we have done corporate risk analysis. So we have done 4 5 topics that are very important from the examination point of view. Okay, I hope you have understood all the things of the Hillier model, this scenario analysis, decision tree, and one is sensitivity analysis. Okay, so let's meet tomorrow with another new topic. And the last topic is the decision making. Tomorrow we will cover the 12th unit, that is decision making. Okay, we have analyzed our risk, we have adjusted our risk. Now it's time to decide the project, which project I will going to choose. So is my decision good or my decision bad? We have seen in unit 9, in unit 10 and unit 11 about capital budgeting decisions, capital budgeting techniques, okay, the tools, the methods, how to analyze the uncertainties, how to adjust the risk. So all these things we have covered in our unit 9, 10 and 11. Now, today is the last unit, that is decision making. See, capital in for any business organization, capital budgeting decisions are not sufficient. They are not just for the financial decisions. They can capital budgeting decisions means that they have to take the decision related to the products also. Okay, how to manufacture the product, what would be the price, what would be the pricing strategy, how to retain the customers. So capital budgeting decisions include all these decisions as well. Now, once decision, how we can analyze that is the decision for any product or services. is good or bad. After doing proper analysis of that decision, then only we can come to a conclusion na, that decision is good or bad. Okay. After analyzing the decisions, so we have different methods to analyze our decisions. So let's start these methods. I hope everything is fine. Okay. Now, the decision making using cost volume profit analysis. So if you make any kind of decision, so we take decision on the basis of two perspectives. That is the cost. Cost means the price of the product, and the second one is what? The volume. Volume means the quantity, the units, all these are included under volume. Now, cost, volume, and the price are important ingredients of any profit analysis. So, how do we do the analysis of a profit with the help of these three variables, the cost, volume, and the price? So, cost has mainly two components, that is the fixed and variable. Yesterday only we have seen that there are two types of cost. One is what? One is the fixed cost, and second is variable cost. Fixed cost is the cost that does not change when there is change in the output, whereas variable cost, these do change when there's a change in output. Like for example, the rent. Okay, rent of a building, rent of a factory, that is what? The fixed cost. Like in variable cost, if you will see the raw materials, the more raw materials you will use, the more production will be there, the more cost you have to incur. Then electricity, the more consumption of electricity you will do, the more is the electricity charges. So variable cost means cost, the cost which do change when there's a change in output. When we produce one output, or we produce 1000 output, so our raw material would be according to that. On one output, our 10 units of goods, the raw material will be comparatively less. On 1000 units of goods to be produced, the raw materials will be comparatively more. So this will change according to the change in the output. And where a company gets its cost equal to revenue, then that company attains the position of break even analysis or break even position. So fixed cost per unit will go down if the volume of production or sales increases. So if the sales will increase, the fixed cost will go down. And if the sales will decrease, the fixed cost will go up. Okay. Now, suppose, let's take an example. Suppose if you produce 1 units of goods, so definitely the cost will be high. If you will produce 10,000 units of product, so definitely the cost will comparatively what? They will go down. The per unit cost of production will go down when you produce more and more units of goods. So why do we produce more and more units of goods? Why? Because there is more sale. So what is written over here is the fixed cost per unit will go down if the volume of production or sales increases. Now, there are some points that affect the investment decision due to cost, volume, and price. When we introduce any kind of new product in the market, we cannot expect high volumes, and therefore the costing will be high. So, definitely, if we are launching any new product in the market, so the cost for launching the product, the cost for gaining attention of the consumers, the cost for acquiring the customers, so definitely they all will be what? High. Now, so large capacity will need huge investment. If the project is large, if the products are large, if the building large capacity will be there, so definitely your payback period will be a little more delay. Like payback period we have studied, na? Payback period means what? Lower the better, the decision criteria. So it will be what? Comparatively delay when you need a lot of investment. So definitely the money which you have invested, you will get back that money after a few period of time. It will be delayed. And those products which are the specialty product, again, such products will require more research and development programs. The research and development expenditure on those products, and those products will be comparatively high. Like iPhone, why it is high? Because R&D is required in more iPad. So all these vintage cars, so these are known as the specialty product, where if you will launch those products, so you will going to launch those product on the high prices. Why? Because the efficiency cost is high, because they need more brand building. So for that we need cost, for R&D we need cost. So for all these purpose, it will require a lot of cost. Done. Now, next is what? business process outsourcing. Next topic, that is we called it BPO. Now, what is BPO? See, if you know, for example, let's take an example. You have got a order of producing 40,000 units of product. Now, so it is difficult for you to produce the 40,000 units of product. Okay, spontaneously, an order came to produce. Now, what you do, you give some of the work to another person to produce for you. Like you are producing 30,000 units of product, rest 10,000 units of product. You have handled this operation to any third party. That third party will complete the 10,000 units of product and they will hand you over. Okay, they will hand you. So business process outsourcing is when a company hires a third party to complete their task, to complete their to handle their projects, to handle their operations, to provide services. That is what business process outsourcing. And for this BPO gets money in return of this. In return of this 10,000 units, the company will pay him the money. This is what the BPO is. Business process outsourcing, when you are hiring the third party for delegating some part of your work to that person. And in return, you are giving him the money. Next topic comes in this. See, in this particular unit, we are covering all the important topics and yes, all the important concepts we are covering in this unit. Now, make or buy decision. See, what happens for a company? Let's take a company name ABC Limited. What happens for a company? Company will see, okay, I'm producing this product, a product is being produced. So company will see that is this product easy for me to produce this product, or I will buy product from any other source and I will uh, pack in my own bottle. I will do the labeling. My own label will be there. Okay, my own packaging will be there, and then I will sell the product. What is easy and what is profitable for me? Either producing the whole of the thing from my side, or I can buy few things like I can buy some raw material, I can buy some products, and after that, I will do the packaging labeling on certain products and I will sell it on my own company's name. So it is called make or buy decision. So it is a choice between manufacturing a product or purchasing it from external supply. Either you can produce it, either you can manufacture it, or you can buy it from some other source and you can take the advantage of that thing. It is also known as outsourcing decision. So in this particular thing, what company will do, company will compare the cost of the product for making the for manufacturing the product, what is the cost, for purchasing the product, what is the cost. After that, the company will compare the benefits. Company will see that what are the benefits I am getting. Either if I will manufacture the product, the benefit I will be getting higher, or to sell or to you can say purchase a product from any other vendor that will give me more benefits. So you will compare the cost and benefit, and on the basis of those things, you will make a proper decision for your organization. That is make or buy decision. Either it is good for you to make a product or it is good for you to buy a product. Now, next comes what? The activity based costing. We also say this as ABC costing. This is very important from the examination point of view. Activity based costing is what? See, what happens in this activity based costing? It basically identifies all the activities in an organization and it helps to assign the cost of each and every activity. Like, for example, let's take an example. Okay, I'm okay. I'm launching a product in the market. Now, this particular product is, let's take an example, hair oil. Hair oil. Once what happens, I have to collect the raw material for this. After collecting the raw material, this has to be go through certain stages. Okay, the coconut I have to extract. I have to bring the coconut. I have to extract its byproduct is done for another purpose. After that, the filtration is used. After that, I will add the chemicals. I will add the organic products again to make it more, you can say, fragranceful. After that, again, the filtration process is used, and then the final product is being made. That final product is packaged, labeled, and then it is launched in the market. So all these steps I have to go through all these steps, all these categories will come. Definitely, all these activities I have to face. Now, every activity has a certain cost. Now, to identify the each cost of the every activity, that is what activity based costing means. For every activity, for every uh, thing, you are calculating its cost, and after that, you are doing the totaling of the cost, and whatever the value comes, that value on that value you will add some percentage of the profit, and then you will sell in the market. So this is what activity based costing. Activity based costing is a costing method that helps you to assign cost for each and every activity in organization and assigns the cost of each activity to all products and services according to the actual consumption by each. Clear? Am I clear with this? Tell me, any doubt to anyone till now? And this activity based controlling is again a method of controlling. Activity based costing. Method of controlling. In controlling also I have explained you this is what one of the methods of control. Now, methodology of activity based costing method. Following terms are used while operating ABC. ABC is what? Activity based cost. Hmm. First is what? The cost object. Cost object tells you that what are the reasons what are the reasons that brings cost in your company. Like you are purchasing raw material, you are purchasing the bottles, you are purchasing the labels, you are purchasing the packing, everything. So it is bringing a cost in your organization. If you want to make a hair oil, you have to purchase the cap, you have to purchase the bottle, you have to do the printing thing on the labeling. So all these things will bring cost in your company. That is cost object. Okay. What are the reasons that brings cost in your company? Now, cost pool is you have to total all the cost, like raw material cost, the labor cost, then the electricity cost, packaging cost, okay, then logistic cost. So all cost, if you will accumulate this, if you will do accumulation of all these costs, then that is what the cost pool. Grouping of cost incurred on a particular activity which drives service or a customer. Clear? Now, cost driver is what? This is any factor that causes a change in the cost of the activity. So, cost of the activity, like for example, if you are producing 20,000 bottles of hair oil, so you will need raw material according to this 20,000. Now, if the production you have purchased any new machinery and you are making more production, you are manufacturing more products. Now, from this 20,000, you are manufacturing 40,000 units of hair oil. Now, for this, you need different kind of raw material. So this is what it is being changed in the cost of the activity. Okay. Right. Cost driver is what? It is any factor that will bring a change in the cost of a certain activity. This cost driver. Clear? Now, some ethical and non-financial considerations relevant to decision making. See, when you make any kind of decisions, like you make any kind of decisions for your organization, for your business purpose. So what you need is that, okay, you can also say this one, I forgot to write. This is cost driver is what? An activity that brings cost or that generates cost. So this activity is generating cost in this raw material. Done. Am I clear? Any doubt? Anyone? Okay. Now, so yes, where were we? Now, see, in making any kind of decision related to product, related to services, related to your business, so you have to follow certain ethics. You have to follow certain ethics, the code of conduct, the moral values. And what are that? The decisions based on ethics are driven by different set of consideration. First, you will see that is it the truth? Okay, is my decision making is truth? Okay, I'm doing this kind of business. Is the survival is more or less? Is it a breach of trust? Okay, if I'm taking like if I'm purchasing any raw material from any other party. So it's not that I will break that thing. Okay, if I have invested or if I have invested on any project. Okay, so later on there should not be such a condition that I will make a breach, I will do the breach or the other party will do the breach. So is it should be trustful. The project should be truthful. It should be respectful from both of the side, from my side also and from the other side also in where I'm investing, where I'm making any kind of dealing. Again, the fourth is what is it responsible that it should be responsibility of me as well as the company's owner. Either me or company both should be responsible if any mishappening occurs in the project or if I make or if any other party makes a breach of trust. So who will be going to responsible for that? Is it fair that is it legal or not? If I'm making any kind of decision related to any product, is it legal? That product is legal, that project is legal. Is it compassionate? That is, we should treat all members equally. That members of the organization plus owners both should have a good relation with each other. Is it civil? Again, it means that is it legal or not. So all these criteria are to be kept in mind while making any kind of decision related to your investment. Character based decision making model, again very important. So it will tell your character. Okay, what is your character? The six pillars of character is a model that help you to determine that whatever actions you are doing for your business, for your investment, for your project, is that ethically sound or not. So there are many models which suggest a framework for deciding ethical soundness. One of them is character based decision model. It provides a framework that can be used to decide whether a decision is morally or ethically sound. The first is trustworthiness. There should be a trust between you and the other party. Respect should be there. Proper responsibility. You should also take, the other person should also take. Fairness, that is, it should be civil and legal. Caring and good citizenship. So these are the six you can say pillar of character in a model for selecting, for determining, for making any kind of decision related to any kind of product or services. So this was all about today. So we have done some of the few important concepts related to this particular chapter. So I hope you have enjoyed the session and you have understood all the important things. Done. So we have like break-even analysis. We have some of the you can say formulas. So let me tell you those formulas as well. No. See, if you want to calculate, if you want to calculate the PV ratio, that is profit volume ratio. This is for cost volume ratio. If you want to calculate profit volume ratio, so what is the formula? That is contribution upon sales into 100. Clear? No. Yesterday we also did break-even points. Break-even point is what? BEP, break even point. So it is calculated on in two types. That is, first is on value and second is on units or on quantity. So on value, we take fixed cost on the numerator, and here on value is there, that is in rupees. So it will PV ratio. In units, the numerator will be same fixed cost and we are calculating on units. So it will be cost per unit. And we have seen the income statement that in sales, if we deduct variable cost, we get contribution. After that fixed cost is deducted, then we will get our earnings. Earnings in the form of profit after tax. Here, okay. Now, so this was the formula, and one more formula of break-even point is that fixed cost upon if contribution is given, contribution per unit is given in the question, then how will you calculate fixed cost upon contribution per unit into selling price per unit? Okay, this is the formula of when contribution per unit is given in the question. Fixed cost upon total contribution into total sales. When total sales are given to you, then how you would calculate? You would calculate like this. So these are the two formulas very important from this perspective. Here, any doubt to anyone? Okay, you can take the screenshot or the PDF is available there, so you can download the PDF. So, hello everyone. I hope everything is clear to you that we have discussed in this particular session. So, I hope you like the video. And if you feel that sessions are helpful to you, then yes, you can comment, you can give your feedback, and you can also enroll in our capsule batch because the exams are very near. We have very limited time for our exam. So make sure you have enrolled in our capsule batch where we will be discussing in a very short period of time the whole of our paper. So every module, every topic, every concept, again we will be revising in our capsule batch. So make sure you all have enrolled in our capsule session, in our capsule batch. So thank you all again for watching this session and let's meet in our capsule batch.